An important notice. Uplifters is not licensed to advise on securities or other investment products. These lessons contain generic information and are for educational purposes only. Investments 101, exploring the what and why of investing. Let's discuss what is an investment and what is not an investment, and why you might invest your money. 1. What is and what is not an investment? Do you know what an investment is? An investment is money used in a way that can make money. An investment can make money in two ways. 1. By paying out income like interest payments or dividends. 2. By increasing in value, and then you make money when you sell it. We call the money you can make from your investment your profit or return. If money is spent on something which has no potential to make money, something that does not make a profit or return, then this is not an investment. It is an expense. Some expenses are necessary and significant, but they are not investments. Buying a TV set is not an investment. It is an expense, and it is not necessary, because it's a want, not a need. Health insurance is not an investment, but it is an important expense. It can cover your costs when you are in hospital, and is useful in case of long periods of sickness and emergencies. However, it does not make money, it is not an investment. A small business is an investment. It can bring you dividends, which means a share of the profits it makes. Also, the value of the business may increase, or sometimes decrease, generating a return or profit when you withdraw from the business, for example if you sell the business. 2. All you need to know about investment. There are 3 concepts you need to understand to learn about investments. 1. Return on investment. 2. Risk. 3. Liquidity. We will discuss return on investment in this lesson, and look at risks and liquidity in the next lesson. Return on investments. We can decide if an investment is worth making by checking how much money it makes, its profit, compared with the initial amount invested. This ratio is similar to the interest rate applied to loans. In the context of investments, it is often called return on investment, or ROI. The return on investment, or ROI, is equal to the profit divided by the amount invested. The ROI allows you to compare the profitability of investments. For example, assume you made 2 investments. In the first one, you invested $2,000 of your money and got $2,100 back. In the second one, you invested $4,000 and got $4,100 back. The profit is the difference between the total amount you got back minus the amount you invested. Both investments made a profit of $100. The ROI for the first investment is $100 divided by $2,000. This equals 0.05. 0.05 is another way to write 5%. The ROI for the second investment is $100 divided by $4,100. This equals 0.025, or 2.5%. Therefore, in the end, the first investment was a better investment than the second investment, because you invested less and made the same profit. The ROI was better. Don't forget that the ROI alone is not enough to decide which investment to choose. The higher the ROI rate, the more the risky the investment is likely to be, as we will see in the next lesson. Why invest? First, let us repeat that you should never invest your emergency savings. Keep them safe in a bank account. You cannot afford to lose them. You need immediate access to them in emergencies. Once you have built emergency savings, investing your money to grow your wealth, prepare for retirement, and protect yourself from inflation is important. Grow your wealth and prepare for your retirement. In the same way that borrowing money costs money, investing money can bring you back more money, grow your savings, and help you prepare for retirement. The returns on investment may themselves grow your wealth, and, if you invest them as well, you should benefit from a compounding effect, meaning you will make money out of the returns you made with the money you initially invested. For example, if you invest $10,000 with a 3% yearly interest rate today and never withdraw money, in 30 years, you will get $24,500, while if you had not benefited from the compounding effect, you would have only $13,000, and if you had not invested at all, you would only have $10,000. This supposes, of course, that you have been able to find an investment with a 3% yearly interest rate, while in reality, there is always a risk you may lose your investment or the interest rate will not be as good as anticipated. It's difficult to save enough money for retirement without benefiting from the compounding effect or investing in an asset that will bring you a regular income, such as a property. But remember that investing money is risky, as we will explain more in the next lesson. Protect yourself from inflation. There is often inflation, meaning the price of goods and services increases. $10 today usually buys you less tomorrow. If you don't invest your money, you risk that your savings will be worth less.